what's your target price for Compass, Albemarle, Livent, and SQM?
Welcome back to Rockstock Channel, and thanks for checking in. Before we launch into the interview, we'd like to thank all our Patreon sponsors. And for those of you who are new, share a bit about us. RK Equity is an advisory firm run by Rodney Hooper and me, Howard Klein. We are exclusively focused on raising awareness about companies producing or developing the next generation critical raw materials that are powering Tesla's EV battery energy transition. Please register your email at rkequity.com and follow Rodney and me on LinkedIn and Twitter. Please also subscribe to this channel, Rockstock Channel on YouTube, as well as Lithium Ion Rocks on SoundCloud for our podcasts. Please note, Rodney and me are not financial advisors or broker-dealers. Nothing you hear in this video is investment advice. Please do your own research and read the disclaimer at the end of this video or on our website. Thanks again for the support, and let's get into the video.
It is Thursday, July 29th. We're very privileged to have Seth Goldstein, who is an analyst at Morningstar. We've called this Morningstar's Lithium Compass because he very much is the guiding light at Morningstar for all things lithium, as he does cover Albemarle, SQM, Livent, as well as 17 other companies, including Tesla and ag companies like Nutrien. He also covers Compass Minerals, which is a new company in the lithium space. Morningstar covers only US listed companies, so not Australian or Canada lithium companies. And there are now 7 ways to play lithium in a fully US listed form. So there are the big 3 producers, as I mentioned, but then there's Piedmont as a developer, Lithium Americas as a developer, Standard Lithium recently uplisted to the NYSE American, and now the newest name is Compass Minerals. Seth, who's been covering Compass for 5 years, I've learned, Compass is a client of RK Equities and an investment, and I learned recently that Seth, over the 3 or 4 years ago, looked at the Great Salt Lake and said that kind of looks like the Atacama, and you're making potash. Isn't there any lithium in there, right? And they didn't say anything until last week. Seth has written a note, and he affixed a $10 a share in Compass's share, which is equivalent valuation of about $340 million.
My name's Seth Goldstein. I'm a senior equity analyst at Morningstar, covering the lithium and chemical space. Also cover agriculture companies, and then I also chair our electric vehicle committee at Morningstar, and through that I cover Tesla. Our EV committee is a committee of analysts throughout the entire EV supply chain that are all impacted by the same EV forecast. So we have our auto analysts on, we have our battery analysts, we even have our oil and gas and utilities analysts on, so that we can all share information and take the same EV forecast and put that into all of our individual company models.
I've been reading your research, I guess, 3-4 years ago, when you were very optimistic on EV demand and lithium demand, outlier optimistic. I remember Livent was one of the first to kind of suggest 1 million tons by 2025, and now that's like almost on the low end of forecast. So what are your forecasts, I guess, for lithium demand in 2025 and 2030?
Yeah, so we think lithium demand is going to grow about 6 times between now and 2030. That's going to represent a sustained, high teens to low 20% growth rate on an annualized basis.
When you say 6 times growth, do you know what your number is exactly in terms of forecasted lithium demand?
Yeah, so we're looking at 1.9 to over 2 million tons of demand at that point.
What sort of EV penetration rates back that number up?
So globally, we're forecasting 30% EV adoption. So we use a regional buildup model looking at the US, Europe, and China, and then different other countries like Japan, South Korea, Canada. Then we make some assumptions about the rest of the world to sort of build up to that 30%. Europe, we're forecasting 50% EV adoption by 2030. A place like the US, we're just forecasting in line with the global average of 30%.
We're very concerned or very focused on profitability of lithium companies, lithium producers, lithium developers. A couple of years ago, we were watching the market, and SQM had a 15 billion market cap, and Albemarle had a 15 billion market cap. This was like 3 years ago. SQM today has a 12 billion market cap. Albemarle's market cap has grown to 22 billion, right? So the market has been saying, we like Albemarle's. And both of these companies are traded like lithium companies, even though they have other businesses. So at the time SQM was at a 15 billion market cap, the contribution of lithium to their overall profitability was something like 50%. And likewise for Albemarle. Albemarle, it's still 50%. SQM, it's like 15 to 20%. However, if you look at the volumes that they sell of lithium, Albemarle has grown only a little bit. SQM's volumes have grown enormously. So SQM has grown their lithium volume, their business has grown very significantly, but their profitability from lithium sales has decreased enormously. And their strategy that they've pursued has been ramp up carbonate, sell it into China, but they're getting quite a low price for that. So there's this argument: lithium is a specialty chemical or it's a commodity. In my view, SQM treats this very much like a commodity, whereas Albemarle, Livent treat it as a specialty. They've had more stable, longer term. It's one thing a contracting strategy, but it's also a quality and a market discipline.
What's ultimately going to determine profitability is where you sell the lithium, the quality that you sell it, and then the pricing strategy. So, for a company like Albemarle, who takes a multi-year pricing strategy, tends to focus more volumes on the higher battery quality lithium, they're likely to see more even profits throughout a lithium cycle, as they don't see as much price declines due to more of their volumes being under the long-term contracts. I think SQM was selling lower quality products, and that's why we've seen profits fall, profit margins fall, and profitability fall as a percent of SQM's total profits. But this seems to be in line with SQM's pricing strategy that they've done for other parts of the business too. If you look at iodine just a few years ago for SQM, they pursued a volume over price strategy in an attempt to gain market share. And I think they did the exact same thing here with lithium in the Chinese market, and we saw prices and profits fall. But now that we are in a more undersupplied market with rising prices, I think SQM's set to capture more upside, and we should see lithium bounce back to a larger part of their profits in a relatively short time period.
Seth, we've seen some announcements recently by Elon Musk in the latest earnings update, which runs contrary to what he said last year at the Battery Day. So less than a year, there's sort of a change. You've got LFP now that he's mentioning, and it's been enjoying a market share rise in China. Do you think that Europe and perhaps the US are going to pay closer attention to the LFP higher carbon footprint?
I think it's very important, especially for the European automakers. And I think they are trying to reduce that upfront EV manufacturing carbon footprint as much as possible. In line with that, I think most automakers in the US and Europe are likely to use the high nickel hydroxide based battery cathodes in their production. I think we've seen the LFP technology in China, but we also tend to see a lower range EV in China. I don't think many US and European consumers are going to sign up to buy an EV unless it's at least 300 miles, if not 350 or 400 miles on a single charge. That's likely going to require either putting in a giant LFP battery or using a high nickel hydroxide based battery cathode. And I think that's the most likely technology to win out in the US and Europe. At that point, I think that will help reduce some carbon as well, since, as you pointed out, currently LFP has a higher carbon footprint than high nickel does.
What's behind the higher carbon footprint?
The energy source to produce all the components. Seth, my view always is if you can get the cost per kilowatt hour at the pack level down to 60 to 80, you can electrify everything, which means I think there is going to be a massive need. And I don't know if you saw this morning, CATL released its sodium ion battery, and basically other than energy density, it was superior to LFP. So they think they can get that energy density up from 160 to 200. And that could potentially, in my mind, tackle LFP on the energy storage side of it, because even if it's slightly lower, if you're not moving it anywhere, it's on the face of it, you'd say, oh, that's a competitive, that's going to eat away at lithium demand. And my view is not. If you can do 60 to 80, I think true gigawatt hour, you look at benchmarks, battery tracker, it's gone from 1,500 gigawatt hours to 4,100 in the last 2 years. And I think it's going to 8.5, 10, and possibly even higher. That's the truth. You think maybe it could be Chinese cathode makers and battery manufacturers that will actually locate themselves in Europe, possibly, and even the US to do it, because I don't see how a foreign company sticking to European regulations on ESG, on permits, on everything else, and wanting a decent operating margin can compete with BYD and CATL located in China.
I think what we would see is CATL building more factories. I believe they're building a factory in Eastern Europe right now. So I think you could see more of those type of locations that would allow them to be near their European Union customers, but perhaps not subject to the same regulations on the battery manufacturing side. But I think what we're also going to see is the high nickel battery plants. We know that from producers like the South Korean battery producers, the Japanese battery producers, we'll see those also locate factories in the US and Europe, and producing that lower carbon intensity high nickel cathode chemistries.
In terms of pricing carbonate hydroxide in your models, what do you forecast as a price when you think about hydroxide and carbonate? And do you differentiate between, are you selling into the China market versus are you selling into the North American and European markets?
Yeah, so we forecast one lithium carbonate price, and we forecast the lithium hydroxide price. Long term, I think we're going to be at around 12,000 a ton in 2021 real terms for carbonate. Long term, I think we're going to be at about 14,000 a ton in 2021 real terms for hydroxide. I think there still will be that premium, but this is for the battery quality stuff. Then when we apply this pricing to each of our companies, we look at what are they selling, what's the quality that they're selling, where are they selling it, what's their pricing strategy, and then we make the adjustment there so that we have one consistent price for all companies, but then it's rolled out based on the company's strategy to go to market. So that's where we're seeing, if I have differences in my model, it's going to be based on the company-driven strategy and less so what they're selling.
I want to turn to Compass. If you could help us analyze Compass, right? Because they're in the salt business, they're in the potash business. This company has like a $2 billion market cap. Their revenues and profit over the last 5 years is, somewhat volatile, but not nearly as volatile as let's say Livent's earnings have been.
When you look at Compass's traditional businesses, salt is a much more capital intensive business relative to their free cash flows than a lithium producer like Livent that's going to be relatively less capital intensive. When you look at Compass, I see a lot of potential with the lithium operation. First, this would be a secondary resource. From their potash operation, it's already an existing brine-based resource extraction operation. So, in my mind, that de-risks a lot of the potential pitfalls that a new greenfield competitor could have. And then Compass is already a profitable company. So from an investor standpoint, there's a lot less risk with them entering lithium that they're going to need to do something like raise capital or repay debt, and they don't have any money, and they have major cost overruns on a project that we see with some of these junior greenfield miners. So, I think from that standpoint, Compass is a good investment. And over the past several years, they have had operating issues in their salt mine. The new CEO, Kevin Crutchfield, came in a couple of years ago, quickly turned the business around. The salt operation is back up and running. Costs are falling, profits are growing. Even in milder winter weathers, Compass is still proven to be very profitable with their current salt operation. So, essentially, Compass had to come in, Kevin had to come in, clean up Compass, restore the salt operation, divest some non-core businesses to clean up the balance sheet, and now Compass can return to growth mode. So that growth mode, the first big investment that was announced was a foray into lithium, which I think makes a lot of sense given their existing brine operation in Utah.
And it's already permitted, right? So permitting is an important component of any mining project, and it's a brownfield. You affixed a $10 value to the lithium business. Could you articulate how you think about, based on the limited information that they put out there?
I had to make a very set of basic assumptions here. First, I'm assuming that Compass goes the partnership route since they don't have the downstream lithium chemical processing experience. So, right there, I'm assuming they sell 12,500 tons of the 25,000 tons by the last year of my model. I'm assuming a relatively lower capital intensity here because, as you said, you can take the Lithium Americas, Caucharí, Olaroz, CapEx line item budget, and you can essentially start crossing off line items that Compass doesn't need. They don't need to dig any more ponds. They don't need to build out supporting infrastructure. Maybe a little bit, but for the most part, that should all be there on the site. They essentially just need to build the DLE process and the lithium chemical plant, and likely some small other line items that are accompanying those items. But essentially, that should be half or less of what Lithium Americas would have to spend, or a greenfield project would have to spend that's brine based. I'm assuming Compass has to spend anywhere from you could range it 125 to 200 million for their share of the project. Then I'm assuming, on an all-in sustaining cost basis, they are able to produce lithium for mid to high single digit per kilogram. And then from there, I just assume they produce lithium carbonate using my $12,000 a ton price forecast. And that's how I get to my valuation for the lithium business. That's how I flow it into the rest of the model.
So you're assuming that they're going to make carbonate $12,000 a ton is the price. You're saying that they're going to produce that in the mid to high single digits.
I'm assuming around 7, yes.
And you're saying 125 to 200 million for their half share. You're suggesting they're going to sell half of the project, meaning you think the total CapEx is going to be 250 to 400 million to build the whole thing?
Somewhere around there, yes.
Okay. And it's fine. Like, I don't know what they're going to do, and you're an analyst, and you're just, this is your crystal ball in this. So, and then you're assuming they're only going to get half of that. So 12,500 tons, times basically a $5 margin. That's like $70 million in profit. I'm just postulating, speculating, kind of like with you. What could happen here? Because right now you're saying it's worth $340 million, right? Is what you think it should be based on the fact that they have a 2.4 million ton resource. That 2.4 million ton resource, by example, Lanxess Standard Lithium has a 3.1 million ton resource, right? So this 2.4 million tons is pretty close to that, whatever, 70% of that number. And Standard Lithium and Lanxess, if you look at that project, the market's valuing that project at more than $2 billion, like $2.5 billion. Just Standard Lithium is getting 30% of that. So the path from like a 340 million value, as they unfold their strategy, right? In their case, they're Lanxess, right? And that's, they don't have the technology. They're working with other technology providers, but in that case, they could have 70%, or they could have more percent, right? They could license a technology, you know what I mean? So I'm just like, I see the potential. If I see Ioneer is trading at a 500 or 600 million market cap, Thacker Pass, anywhere between 500 and a billion market cap. Piedmont's at a billion market cap, Standard Lithium, and then Vulcan in Germany is trading at like a 800 or 900 million market cap. So like the tailwind behind DLE stories is strong. GM and Stellantis are, we don't know what the valuations are of their MOUs and investments in, Salton Sea, geothermal, et cetera. But there's a tailwind to DLE that I think Compass could benefit from. You're one of the few analysts, right, who actually cover Compass and lithium companies. There are other analysts who cover Compass that don't cover lithium.
There's certainly a lot of moving parts, and I will be updating my model as soon as we get more information, as soon as we get, further along the project development process for Compass. I will say that my base case was the $10 a share for Compass fair value. If I look at my bull case scenario, we could see something closer to $1 billion valuation on the project. In my bull case, I'd assume Compass goes at it alone and is successful, has slightly lower production costs, and is able to essentially do this thing themselves. As the strategy unfolds, as we get more information on things like capital intensity and projected operating costs per ton, then I will update my model accordingly. So, but again, in an upside scenario, where Compass does everything themselves and is successful and is able to get those costs down a little bit, we could see $1 billion valuation for the lithium operation.
Sounds good. So just let's end here. What's your target price for Compass, Albemarle, Livent, and SQM?
My fair value estimate for Compass is 88 a share. My fair value for Albemarle is 145 a share. At SQM, I'm at 60 a share. And then Livent, I'm at 18 a share.
18. Okay, so Albemarle's already over that price, as is Livent, and SQM is under that. So you actually are more bullish SQM than the other two, and Compass is at $67, so 88. There's more upside than all of the others.
Yes,
to your base case.
Yes, and a lot of that has to do with continuing to drive lower costs from the salt business, and then higher prices from the upcoming winter bid season that will be for the 2021-2022 winter. So I think that will be a big near-term profit driver for Compass.